Hey guys, Adam Rose, Vice President and Senior Loan Officer for Western Ohio Mortgage here in Sydney, Ohio. Today is another episode of the Mortgage Guy podcast, and today we're going to discuss some updates from FHFA, how that's going to impact some people. Again, you're not going to see a local impact, but nonetheless, it is news. And we're also going to be discussing the new, well, it's not new, it's trigger lead regulation that's been sitting in Congress. It's going absolutely nowhere for quite some time now. So let's dive in. So FHFA, what is that? So that's the Federal Housing Finance Agency, and they're the ones that kind of regulate, oversee what Fannie and Freddie are doing and keeping them out of trouble. All right. Ever since 2008 with the meltdown, they've been under conservatorship. So FHFA kind of make sure they're following certain rules. They're not overextending themselves. They're not going after too many aggressive investment options in the mortgage-backed security market. So, anyways, they are trying to tackle rental affordability challenges. The FHFA is raising multifamily loan caps for Fannie Mae and Freddie Mac in 2025. I don't know if that's really going to do much, to be honest with you. They're doing what they think is best. But the FHFA has increased each enterprise's multifamily loan purchase cap to $73 billion, a 4% boost from 2024. Creating a combined $146 billion in available market support. And these caps align with the agency's annual conservatorship scorecard priorities and reflect evolving market needs. In a nutshell, okay? So we talk about $73 billion, $146. Remember, so FHFA is managing Fannie and Freddie, okay? Those are two different options when you go into the conventional world. They have different findings. They're different programs, okay? So they manage both of them. So you have $146 billion available for them to invest in or purchase mortgages from lenders in the multifamily category. So why they believe this might help decrease rent expense? Well, one of the biggest reasons is, first off, let's talk about this. First off, I want to remind people that because they're tackling rental property purchases for investors is really what that's geared towards. But just a reminder, if you are an owner-occ, you can still buy a multifamily home with 5% down as long as you are going to live there. That is key, all right? It's a great way to start your portfolio. It's a great way for a young person coming out of college, high school, whatever, as long as you have solid job history and good credit. Move in a property, have the other half pay your mortgage pretty much. Maybe not all of it, of course, but help limit your out-of-pocket expense for your housing. So anyways, where they're going with this, okay? So the first option, if you call me and you're looking to build up your rental portfolio, the option one is always looking at a Fannie or Freddie product for an investment property purchase. Down payment ranges will vary. I highly suggest hitting 25% down. That's typically the sweet spot in regards to your rate and your terms and costs associated with the loan. So with that being the best option because it's less expensive, there is a limit on what you can do with Fannie and Freddie. I mean, the maximum amount of homes you can have financed is 10, okay? So you do run into a cap if you're building a pretty large rental portfolio using conventional financing. They're going to cut you off, okay? Maybe you don't qualify based off of credit. Maybe you don't qualify based off of something going on in your credit profile or work history or income, whatever it might be. So people that still don't qualify for a Fannie or a Freddie product still want to build up their rental portfolio, so they move over to the DSCR realm. They move over to the bank statement program realm. And so where FHFA is coming from, by expanding the available capital for these loan programs, they're hoping more people use Fannie and Freddie because it keeps the cost down for the person getting the loan, right? So the landlord in this case, right? They're trying to keep those costs down, keep the rates down. Is it going to have a massive impact? I don't think so. It's going to have some, right? I mean, it could be the difference between, $40 or $50 a month in regards to expenses for a tenant, possibly. I mean, that's doing something at least. I mean, they can only do so much from where they're at to tackle this. So why is it more expensive to do those other options? Is because when you're doing a DSCR, or you're doing a bank statement loan, is a little bit higher risk, right? So a DSCR loan is really not evaluating your income as a borrower or an investor. They're really looking at the property, all right? Because the property is a collateral. It's all about the property. They want to know that you have the credit score to do this, and you're going to repay it, and you have the down payment for it. Those are the primary things from the consumer that they're looking at. Everything else is property specific, right? The value of the home, the down payment requirements, loan to values, all this fun stuff. But they're making sure the home is going to cash flow. That's the whole purpose of a DSCR loan. Bank statements are very similar. It's just a little bit different, right? They take the pay stubs out and the W-2s out, and it's just bank statements to calculate your income. So on the DSCR, they're just trying to make sure that, okay, let's try to do an example here. Your mortgage payment is $1,000 a month, okay? And it's a multifamily maybe. And when the appraiser goes out there, they're going to do something called a market rent analysis, which makes these appraisals just a touch bit more expensive than traditional. But they're going to ensure that the market rent is going to be at or above your mortgage payment. Now, there's a lot of non-QM lenders that will do a lot of different stuff with DSCR. I see a 1.0%, or, well, just one, right? 1-to-1, basically, ratio requirement. Okay, so what that means is as long as that market rent analysis is going to hit $1,000 a month and your mortgage payment is $1,000 a month, you're probably going to go to closing. Now, if it's that close on the ratio, your terms may not be as good. Rate could be a little bit different. Cost could be a little bit different, right? They give you incentives if you're finding a better deal. So the market rent analysis says it's $1,500 and you're at a 1.5 ratio. They love that. They find that to be a very, very low risk loan for them, right? Because the cash flow is going to be so good. You could lose a tenant on one side and still be damn close on covering your mortgage payment. So they're all about that. So there's going to be some incentives, some pricing incentives, maybe changes in down payments and stuff like that. So that's what FHFA is talking about. They're trying to keep people in the conventional space, the Fannie and Freddie space for investment properties, or first-time investors maybe, to keep your interest rates down and keep those costs down, which, right, in turn should keep the rent down a little bit. They might be a little overzealous thinking that this is going to fix it or help, but it might help a little bit, right? Because in comparison, doing the bank statement loans, the DSCR loans, you might have an 8.5% rate, a 9.5% rate. It might be, it's 2 points higher, probably. All right, so that's what they're talking about here with that announcement. So hopefully it does help. Hopefully it has some impact on the market. It's not going to be huge, but it might stem a little bit, right? It might stem a little bit. Maybe I'm just being glass half full. I don't know. Anyways, trigger leads. So this regulation has been going on for quite a while now. The Ohio Mortgage Bankers has backed it. The National Mortgage Bankers Association has backed it, of course, and helped produce this legislation with congressmen. But I'm just going to read this piece to you. So Congress is currently debating how to regulate mortgage trigger leads with Senator Jack Reed's bipartisan Home Buyers Privacy Protection Act, including in the fiscal year 2025. The amendment would prohibit unsolicited communications, calls, texts, emails, or mail, unless authorized by the consumer, shifting from an opt-out to an opt-in model, right? That makes sense. We've talked about trigger leads before, and the big thing here is, as a lender, if you're a lender watching this, you're probably not watching it because you probably don't like me, but that's fine. We try to communicate with our clientele saying, hey, that's kind of when soft pulls got to be such a big thing, was to eliminate these trigger leads. But anyways, talking to your client, saying, hey, you know what, we're doing this pre-approval. When we do this, we're going to pull your credit. Heads up, right? This is your part. You got to advise. If I do this, you are going to get 1,000 phone calls in the next 5 minutes. I've had clients sitting across from me and said that this is what's going to happen, and it's going to happen in like 5 to 10 minutes. And while we're still in the meeting, they got phone calls. All right. So when we pull credit, TransUnion, Equifax, and Experian, the big three, they sell data, right? That's how they really make their money, is selling data. So they sell leads to anybody in the mortgage industry that buys from them, right, in buckets. So there's going to be credit score buckets and things like that. They know a mortgage company pulled the credit. Okay. There's a specific code, ECOA code. When we pull, it registers as a mortgage company finance. So they sell that out, and people get blasted with phone calls. Well, there is an optoutprescreen.com. I believe that's the website. Justin, if you could research that and put it across the bottom for me, please. Put that on there so people can go out there and opt out. So what that is you can do an electronic opt-out, and I want to say it's 5 years. You'll put in some data and information, opt out. You shouldn't get those phone calls, okay? At least you should not get them from lenders that are buying leads from the bureaus. It's not to say that you still won't get junk mail to death, but that's how that's going to work. There's also a mail-in option where it's like for life you are opting out. Takes a little bit longer. People usually don't do that, but it's a nice, easy way where if you're about to start shopping for a mortgage and you don't want to be hounded to death with I call telemarketing calls because you did not ask for that phone call, and that's a good way to get out of it. Okay, so look into that. And so what the pushback is the Consumer Data Industry Association, the CDIA, counters with a plan banning unsolicited calls but allowing texts, emails, and mail offers with a 2-year delay for implementation. So it's still 2 years out. I don't know why that would be such an issue. Again, the credit bureaus are really pushing back on this because they make a ton of money on selling this data. But texts are still a little annoying. But the nice thing is there should be an opt-out option. Like everybody gets it, especially this political season. It's been nuts, right? Constant text messages. You click stop or type in stop, send it, and it's supposed to stop. But then someone else from somewhere else is starting to text you. So that's the kind of the concern I have with continuing with at least the text. Email's not a big deal. Delete it. You can probably click an unsubscribe button. But and I think a lot of lenders out there, a lot of clients out there that have experienced this, there's a lot of questionable activity that happens on these trigger calls, and trigger leads, right? When they're calling you, trying to sell you on buying through them or financing through them. I've had clients tell me, yeah, I've got a call from this guy out in California with Texas. It's all over the place. All right. There's no geographic discrimination here. So they would say they're related. Yeah, yep, with Western Ohio Mortgage, a different name, and it just sounds fishy. They give you crazy low rates over the phone. There's a lot of weird stuff that happens with it, so you got to be careful. And some people get baited into it and move forward. And it's not to say that they're not legitimate lenders out there, but they're going to tell you whatever they want to tell you just to keep you on the phone, so they can get you locked in and then deal with it later. It's one of those, don't ask for permission, just ask for forgiveness kind of a thing. So that's what's going on. Again, use that website, go there, opt out, and that way you're doing your own shopping. The whole argument from the credit bureau side is if you remove it, it removes the buyer's ability to shop. No, it doesn't, okay? If you want to go shop lenders, right? If you find a lender and you're happy with the rate, you're happy with the service, you're happy with the cost, whatever, and you want to stick there, that should be your right to do that, okay? So that's where I'm at on it. But I hate them. They drive me crazy. They drive my clients crazy. But as a lender, you just got to coach your clients and give them a heads up. That's all you can do. So hopefully that stuff goes through here sooner rather than later, and we can all move on with our day. Anyways, this is Wednesday, the Wednesday before Thanksgiving. So, guys, I hope you have a fantastic, fantastic holiday and a couple days off. Don't do too much shopping. And remember, if you're in the middle of the loan process right now, do not take out any new credit cards on Black Friday to save your $20 at Kohl's. All right? Just don't do it. It's not worth it. It's not worth the fight. We're going to find it, and we're going to call you on it. So try to avoid that. But remember, it's a great opportunity for you to get with your family, have some good food, talk politics, a lot of fun, create some fights, great memories. All right, guys, that's it for me this week. Hopefully you guys can catch up with me next week, and we're all fatter from the meals that we just had. So remember to subscribe on YouTube. Check us out on Apple Podcasts and Spotify, and we'll catch you all next week.